Hi, good day, and thank you for your time to take a look at this 10-year financial model with the DCF and other valuation methodologies by the company Doctor. Purpose of this video is really just to provide a brief summary and overview of the functionality of this model. And in addition to the screenshots that we've provided on the platform, giving you an overview of what you can expect, we wanted to also provide you with this free video just to run through the high level components of the model so that you can judge the functionality for yourself and see whether this model will add value to the purposes that you have for either your startup or existing business. So as a point of departure included in the model, we just provide whoever the user is with a broad overview of what they can expect in the model. Primarily throughout the model, the purpose is for the user to input their various assumptions to test the viability or financial feasibility of the model. And how we guide our users is wherever they see the yellow shaded blue text cells, that is where they can overwrite and input their own figures there, which will automatically drive the rest of the model. So as a start, the dashboard that we provide, the dashboard with the annual financial projections, is all housed in this first sheet. It starts off with a high-level dashboard based on a completed model. You will see the first input that is required by yourself would be to decide on the investment period. So we've allowed for a toggle between 3 and 10 years and made it in such a way that if you do toggle between the various years, everything else throughout the dashboard and the model will automatically update. Moreover, the model itself will also just be cleaned up with the years that is not applicable, like the case is here. If you take a look at the inflationary figures, you will see the rest of the model for the years that you not interested in is automatically taken out of the model. It makes life easier to read the model and to follow the logic. So throughout these master sheets, the dashboard, the valuation sheet, and the month-to-month financial model, we've built checks and balances to see firstly whether the model itself has have any errors, and secondly to make sure that the balance sheet and the rest of the projections are actually in balance as you progress. It makes your life easier when you start inputting figures, just to see whether there are any errors, and if there are an error you can very quickly trace it based on the inputs you've made. The first check here is obviously whether the balance sheet is in balance, liabilities and assets, but then also checking based on these various assumptions that's made throughout the model whether there is sufficient cash flow, and in this instance sufficient cash in the bank. Which will make life easier as you progress through the inputs to see whether additional funding and so forth is needed, or whether you need to adjust any of your assumptions. So now this model itself can be used by both startups that's interested in an extensive model looking at various decisions in terms of funding, but also looking at their company valuation throughout the period of 3 to 10 years, but also for existing companies, allowing for the previous 2 financial years or audited financial statements or actual historical figures to be input as well, which makes it easier. Let's say for argument's sake you have 2 years previous years financial figures, and you want to now project forward from actual figures or actual performance. It just makes the model easier to follow the logical thought based on balances and actual audited financial statement balances that's been used as opening balances for the projections moving forward. Also, a lot of the funders that we deal with want to see that as well in the projection, so that they know you're not projecting as an existing company from a zero base, there are actually financial figures that drive certain assumptions. So to make it easier for the person using the model, we've split the assumptions between general assumptions. So this is where things like inflation, taxation, working capital is addressed. Also, if you carry on further, the second major component is the funding assumption side, and here we've split it between debt and equity. Once again, if you start playing around with the equity portion that you expect, let's say there's no equity, you will see automatically that it defaults to 100% debt. And if you look here at the top, this is the dashboard component, the power of this dashboard component that I mentioned earlier. It automatically shows you, based on your funding structure of pure debt, you don't have enough funds to actually fund this business, and there is additional funds needed, in this case before year 2. So immediately at this early onset, you can immediately see that the model won't be viable based on the assumptions that you're currently making. So if we default back to where we were, we've split it between new debt funding. So these are the new business loans or debt structures that you will take on board. We've allowed for things like your lending rate, or the country lending rate, or regional lending rates, plus the lending rate or interest rate that you will qualify for. We've adjusted for tax, cost of debt after tax, for purposes of the WACC calculation, which we'll touch on shortly after. Loan term, we've allowed for the loan term as well as built in a potential moratorium. So you may be in a position where the funder allows for a year or 2 or 3, in some instances, moratorium or loan holiday. This is automatically calculated throughout the model for you based on these assumptions. Then we've allowed for existing debt. So based on your financial statements as an existing entity, you may already be sitting with some debt on your books from one or various funders. This is where these parameters are included. And the idea is to adequately allow for the principal and the interest repayments on the balance sheet, so that once again, whoever reads the financial model can very easily see that you have allowed for existing debt in the business, but also it will obviously impact your cash flows and at the end of the day your company valuation as well. Moving on to equity, once again, you may be in a position where you've already allowed for equity funding, and here we've split it between the equity that funders hold versus the equity that's already been relinquished to external partners in addition to the funders or the owners of the business, and which will bring you to the what if scenario of, if you had to take on new equity at this stage, how much equity is available. And needless to say, based on the equity that the owners hold minus the 20% that external funders hold, there's 60% that can be offered to additional equity partners. Now, this what if scenario is quite a powerful tool that we've built in for whoever uses this model. You'll see that the valuation at the top here is derived from the company valuation sheet, which we will discuss briefly. It's split. The primary methodology that we use is the DCF approach, but we've also, as a value add, given the EV/EBITDA approach as well, multiples approach, and then the perpetuity approach as well, which we'll discuss in the company evaluation. And this is just for comparative purposes. So we've split it between the actual enterprise value, and then based on the adjustments for net debt, in other words, debt and cash, we've allowed for the equity value as well. So whoever reads this model, some funders want to see the enterprise value, some funders want to see the equity value, some equity partners want to see just the equity value. It does allow for all of that. And you'll see here as well, if you toggle around, let's say go to year 7, it automatically updates this and shows you that this is the value at exit year 7. So once again, quite a powerful formula that's been built in there. Coming back to the what if scenario, so now you want to decide based on the funding amount that you're seeking, which is this case here. We said we need a total funding of which 121 million will be equity funding. And the biggest question we get from funders and clients alike is, how much equity do I give away in the business based on the current projections? Now, obviously everything is based on the valuation, and as soon as you start playing around with the discount rates and various assumptions that drive the valuation, your equity portion or proposed equity portion will also change up or down. Now we've built in a little toggle here that you can play around with and say, okay, well, based on the discounted cash flow of 800 million in year 10, what would be the value of equity for, let's say, 7%? And that gives us 56 million. And so you can play around with these various 5 assumptions. But what you want to know is, for negotiation purposes, what is the acceptable level where the potential partner, equity partner, will neither pay a premium or neither receive a discount for the 121 million. And this is where this is automatically worked out for you. So based on the valuation of 800 million and based on the 121 million that you're seeking from an equity partner, a 15% plus minus stake in the business will be a good point of departure for your negotiations. You'll see the text here as well. Guideline text automatically updates as these assumptions are changed. So immediately, just by reading these text prompts, you will be in a position to make a clear input decision whilst you play around with the model. Having looked now at both existing and new debt and equity, looking at the cost of capital is very important, and we've built in all these parameters that drives the weighted average cost of capital, or the WACC, including the beta. And needless to say, this will be based on your specific region. Your country risk and your risk-free will be based on your specific region. We've used an example here of South Africa. You'll see throughout the model as a value add, we've added cells here that have notes to say read notes. As soon as you hover on that, it will give you a brief explanation. In this instance, what we talk about when we talk about risk-free rates, or in some instances an example of what the thinking is behind the various calculations. So now that we have the WACC based on the mix between debt and equity funding, we can then move on, and we've built in another value add to whoever uses the model, and this is the sensitivity analysis to look at what would the discounted, remember the discounted cash flow approach for our valuation is our primary approach. The multiples and book value, etc., that we use is just for comparative purposes or free value adds. But now if we look at the discounted cash flow, to look at the sensitivity, if we had to change the terminal growth rate or the WACC rate, the sensitivity will automatically update here for you. So once again, it puts you in a very good position to prepare yourself prior to discussions with investors or partners or management team. And you'll see here, if you play around with this figure here, automatically everything updates accordingly. All right. Okay, so this won't be applicable, the value, because it brings it to a minus figure here or a zero figure here. So don't have to worry about that. That makes sense accounting wise. So if we go back to a terminal growth rate post forecast of 1.25%, it automatically will show you what the enterprise value is that you can expect there. But also, if you go to the bottom, what the equity value would be. That figure there automatically updates. All right. Talking about the multiples approach, here we've given an example of who we use in our company as one of the sources. You obviously may have your own sources, but yeah, whatever multiple you include here based on industry comparison or peers comparison, it will automatically update the multiples value there. So if we change it from 9 to 10, you will see that both these figures have changed. If you go back to a lower figure of 4, it automatically changes there for you as well. The funding components, just a summary of what we've discussed a bit earlier. And then the third component of the assumptions are the operational side of things, and this is where we include components in terms of production capacity. If you're talking about a production company or a manufacturing company, variable versus fixed production, which drives the rest of the assumptions. On the sales side of things, we've allowed for 10 product or service lines or categories as placeholders. So if we change this to product X, Y, Z, it will automatically update throughout the rest of the model for you, just for reference purposes. This is where you input your sales figures. The inflationary percentages that you've included at the top of the model is automatically linked to the subsequent years, but it's been left open. So if you don't want to use inflation, a straight line inflation or a specific inflation figure, and you want to include your own figures here without inflation, these cells have been left open for you to play around with. Production capacity, as I mentioned, production capacity there will automatically link to whatever your decision is here, whether it's variable production changes or whether it's fixed. Your actual performance based on what your production capacity is, which will then calculate your actual performance in units. And then here we've allowed for your decision whether some companies want to express their cost of sales or cost of goods as a percentage of sales or as a cost per unit. And if you go the cost per unit route, it will automatically open up this section here for you that you can actually put in your cost per unit. All right, and then you'll see that the income statement, balance sheet and cash flow is provided. For the historical figures, these are the actual figures that you would need to input if you're an existing entity or company. Based on your financial performance or your annual financial statements, you would actually put in your actual figures here based on what you've received from your accountant or auditor, and it will just tie up with the balance sheet itself. But here you'll see the projections based on what we've assumed earlier will automatically update throughout the model, right through to the net profit, net income. There your balance sheet updates. All these checks are in place to ensure that everything remains at zero. Just to reiterate the fact that all these checks and balances are put in place not only for the purpose of keeping the model viable or checking for errors, but also give you an indication once you go through the model to make sure that there's no errors that's been made in your calculations. Cash flow, once again, this balance, opening balance, cash balance is based on your actual figures from your accountant or your financial statements. And then towards the conclusion of the dashboard, the financial ratios automatically updates everything from working capital to your cash burn rate, your various liquidity ratios, staffing ratios, all your schedules that drive the debt and balance sheet components. Everything is updated here, you'll see, with all the various checks and balances in place. And then there's about 10 to 12 various graphs that automatically updates as well as you make changes. For those that want graphical representation, whether they want to use it in their own reports, company reports, or business plans or pitch decks, that's already been designed. Just to run through the rest of the model, we've included a financial model component for month-to-month projections for the first year, so the first 12 months of the projections, and allowing for seasonality across the various product and service categories, which may apply in some industries or some clients. And once again, the income statement, balance sheet that's expressed based on these inputs are automatically updated. Here you'll see at the top the dashboard corresponds to the actual dashboard section on the dashboard sheet. So once again, just for you to have a quick and easy overview of what's happening with the model. And the company valuation, these figures here, this is where this happens. Once again, everything is worked out automatically calculated based on your inputs. There's no additional work needed by yourself. You'll see that the unlevered cash flow is calculated, so too the levered free cash flow. The return on rate of return for both levered and unlevered is automatically calculated and pulled up to this top section here. The various valuations are the discount, the multiples, the perpetuity approach, and then just an average between the three. So whoever looks at this will see, okay, well, wow, plus minus 800 million will be the value of this company if I exit in year 10. So these are the three master sheets that will guide you in your decision making, but also assist you in giving you very detailed, advanced insights into the financial model. Just in conclusion, I'll quickly run through the 4 input sheets that drives the rest. We've got the funding side, so this is for the new funding that is expressed in the various assets and non-assets that you can decide. It allows you to give quantity for those assets, the values, descriptions, and then at the bottom it automatically updates everything for you, graphic wise as well as table wise. Also, if you had to remove the section here, let's say we didn't allow for contingencies and up our funding amount, you'll see automatically the model will tell you, listen, we are in a negative cash balance, we need additional funding. Depreciation automatically calculated. Here you'll see previous year's assets, in other words the closing balance of assets based on your historical actual performance. It's all automatically pulled through. And whatever your assumptions are in terms of the useful life of the assets and the salvage value, your depreciation will automatically be calculated and pulled back to the 3 financial statements. A last component here, any additional capex across these various categories that you want to add in subsequent years from year 2 onwards can be done here, and this will automatically draw back to your cash flow and your balance sheet, as well as your supporting schedules. Your operating expenditure, once again, you've got the opportunity to look at or change the various labels based on what your categories of expenses are for OPEX, along with your figures. And then whatever you write in here and input here, these will automatically be pulled back. I'll show you here, it will be pulled back to the dashboard. In the income statement, there you'll see the figures automatically pulled through, and then it allows you then for the year 2 onwards to adjust the figures or project the figures based on either inflation or whatever your internal methodology is. And then labor, the last major input sheet, split between direct labor, which we link back to the direct cost of sales, as well as indirect labor. You'll see everything is hidden until such time as you select. It's just to make the model cleaner and easier to read. As soon as you select there, it allows you to start inputting the quantity, the years of appointment from years 1 to 5, and then right at the bottom the checks and balances are in place to show you the total headcount per year across the 2 categories. So just in conclusion, we spoke about the existing debt and new debt that you have in the company or may have in the company. You will see that the existing loan or 2 existing loans have automatically been pulled through to this amortization schedule. Automatically calculates the principal and interest, which then pulls through to the income statement, the balance sheet, and the cash flow. So there's no work needed here. And then based on your loan parameters for your new loan, whether it's with a moratorium, loan holiday, or without, once again, this is automatically done for you. It gives you an example to show you, okay, what is the loan going to be, the new loan going to cost me if there's a moratorium of 1 year versus no moratorium. And it just allows for easy management decisions once you get all these figures. So that's the sum total of this high-level overview. I trust it helped you, and it would allow you to make an informed decision as to whether this financial model will work for the purposes that you have for your company, whether a startup or an existing company. And please, if there's any questions from your side, you're more than welcome to contact the company doctor, and we'll be happy to assist wherever we can. Thank you very much.